Tomorrow morning, January 19th, 2026, a door quietly shuts in the global silver market. And most people won to even notice it happened until it is too late to undo. Right now, as you're watching this, 3 different forces are sprinting toward the same finish line, and they're doing it for one reason. Physical silver is slipping out of reach, not the silver on a screen, not the silver in a brokerage statement. Real metal, bars, coins, industrial stock, something you can deliver, fabricate, and actually hold. Because what happens in the next 24 hours won't just move prices. It will decide who ends up owning the metal, and who ends up owning a promise that can't be honored when it matters most. You can see the fracture spreading across the world in real time. In Dubai, physical silver coins are selling for roughly $125 per ounce, while the futures price on your screen hovers around 89 ounce, a brutal premium just to escape paper. In Japan, secondary markets are touching $150 per ounce, a number that sounds impossible until you realize buyers there aren't paying for silver as an investment, but they're paying for certainty, paying to be first in line while everyone else argues about charts. Shanghai trades above $80 consistently while New York lags behind by double digits. And this is not normal market variance, not a temporary inefficiency, not some harmless regional quirk. This is separation. This is divorce. This is the moment when the metal stops obeying the paper price and starts obeying the laws of scarcity. And tomorrow is the moment that separation becomes permanent, because tomorrow is when deadlines converge, delivery notices accelerate, procurement cycles tighten, dealers run out of time. Approved exporters complete their first full cycle inside China's new licensing system. And for anyone short silver, anyone who sold contracts believing the metal would always be available when the delivery window arrived, tomorrow becomes an audit. Not an accounting audit, a physical audit. The kind that doesn't care what your balance sheet says. The kind that asks one simple question: can you deliver what you promised? This is how you should picture it. For decades, the silver market operated like a high-speed highway built on the assumption that almost nobody would ever exit at the physical delivery ramp. Futures were traded, positions were rolled, cash settlements were accepted, and the system survived because physical delivery remained mostly theoretical. But now industrial users are demanding real metal because they can't function without it. Banks and dealers are scrambling because short positions are colliding with delivery requests. And China, quietly, methodically, has placed a gate in front of the world's refined supply. Suddenly, that exit ramp is crowded, and the highway was never designed to handle everyone leaving at once. So if you've been wondering why this feels different, why the premiums are exploding in multiple countries at the same time, why people are paying what looks like absurd prices compared to the official number here, where's the truth? The market is telling you that physical silver has moved into a new category. It's no longer just a precious metal. It's a strategic commodity, one that powers the modern world and one that is now being rationed by reality. Tomorrow morning is when the market stops pretending otherwise. The first group racing the clock is the one most investors never think about, because they aren't investors at all. They're industrial buyers. They're the procurement managers inside solar manufacturers, EV producers, semiconductor fabricators, people whose job isn't to beat the market, but to keep factories alive. Industrial demand already consumes more than half of all silver production. And unlike investment demand, it doesn't politely step aside when prices surge. A solar manufacturer can't replace silver paste with wishful thinking. An EV company can't wire electrical systems with optimism. Semiconductor fabrication doesn't pause because the futures curve got inconvenient. These companies need metal the way the body needs oxygen, continuously, predictably, and without negotiation. Now, layer that reality over what happened on January 1st, when China implemented export licensing restrictions that effectively tightened access to a massive portion of global refined silver flow. This wasn't a dramatic headline ban. It was something more powerful, a gatekeeping system. A framework built to decide who qualifies, who gets access, and who pays the price. Requirements like enormous production thresholds and deep credit lines don't exist to create order. They exist to limit the number of players allowed to export. And when industrial buyers realized that a primary artery of refined supply was being squeezed, they didn't start debating theories. They started paying premiums. They started bypassing normal channels. They started approaching miners directly, offering above-spot pricing for immediate delivery because the alternative isn't missing profit. The alternative is missing production. Imagine being the person responsible for procurement at a major manufacturer. You have contracts to deliver goods. You have deadlines, penalties, customer expectations, supply chain dependencies stacked like dominoes. The factory doesn't care about the COMEX print. Your workers are showing up whether silver is cheap or expensive. Your line either runs or it stops. And when it stops, you don't lose a trade, you lose a quarter. You lose market share. You lose momentum. That pressure is what creates a new kind of buyer, a buyer who treats silver the way nations treat fuel in a crisis, not as an asset, but as a requirement for survival. And here's where you should pause for a second, because if this is making sense so far, take one moment and hit like, not because it helps the algorithm even though it does, but because this is one of those stories that gets buried under noise, and the only way these realities break through is when enough people push them into the light. The second group sprinting toward tomorrow is the group that actually helped create the illusion we've all been living under. Banks and dealers, the institutions sitting on short positions. They sold contracts promising silver delivery at $70 or $80 per ounce, confident that when delivery time came, they could always source metal the way they always had. Historically, most contract holders never asked for delivery. They rolled forward, settled cash, treated physical as optional. That assumption wasn't stupid, it was just old. And in the last few weeks, it started cracking. The proof is in the behavior of contract holders themselves. Instead of rolling forward into later months, traders began rolling backward, moving from March into January and February, positioning for immediate delivery instead of future exposure. That's not normal. That's not trading. That's urgency. It's the market whispering that time is becoming more valuable than price, because in a shortage, waiting is a form of loss. And for the banks and dealers, that shift is a nightmare, because it turns their paper game into a physical challenge they might not be able to meet. Here's why this becomes dangerous, and why tomorrow matters so much more than a calendar date. In a futures market, everything is built on trust. Trust that the delivery mechanism is real, and that the inventory beneath the paper structure is solid. COMEX tracks eligible inventory, which is metal stored in approved warehouses, and registered inventory, which is metal actually available for delivery against contracts. Eligible sounds comforting, but registered is what matters, because registered is the metal that can be handed over when someone shows up and says, "I want my silver." And registered inventories have collapsed by roughly 70% since 2020. That is not a minor drawdown. That is the foundation shrinking under the entire structure. In normal times, the ratio of paper claims to physical metal can be absurdly high, because the system assumes delivery requests will remain rare. But when industrial buyers start demanding metal out of necessity, when dealers must cover short positions before a default becomes visible, and when major supply routes tighten, that fractional reserve structure faces the one test it was never built to pass: mass demand for reality. It is like a bank that operates comfortably with fractional reserves until the day depositors stop trusting the institution and show up at the same time. Suddenly, the math becomes brutal, and you can see the physical stress showing up through every leak in the system. Lease rates spiked above 8%, the highest in years, which is what happens when institutions can buy metal easily and are forced to borrow it at punishing rates just to survive short-term obligations. Think about what that implies. In a healthy market, you borrow metal when it's cheap and plentiful, like borrowing money when interest rates are low. In a stressed market, borrowing becomes expensive because the people who actually have the metal know they hold power. Elevated lease rates are not a random metric. They are the price of desperation. Then there's the third group, the one that quietly benefits from all of this while everyone else scrambles: Chinese state entities and approved exporters. Most people misunderstood China's January 1st move as a simple restriction, but the deeper story is leverage. It's about control. A licensing system doesn't eliminate exports. It centralizes them, decides who earns the right to sell, and places influence over who receives supply and at what cost. When you hold influence over a massive portion of refined silver flow, you don't need to panic. You can watch others panic. That's why Shanghai's physical pricing consistently sits above Western futures. It isn't just a regional premium. It is a signal that Asian physical markets are pricing silver as a scarce strategic resource, while Western paper markets are still pricing it like a tradable contract. And when you have Chinese entities accumulating metal at their own reference price while the West fights over paper claims, you are watching a slow transfer of advantage, metal moving toward the places that understand scarcity first. Now bring those three forces together: industrial buyers who cannot stop buying, banks and dealers who cannot fail delivery without triggering systemic consequences, and Chinese entities that hold leverage over supply while watching Western inventories thin out. Tomorrow is when their timelines collide. Delivery windows tighten. Settlement points hit. Procurement needs converge. This is why the 24-hour window is real. It isn't magic. It's logistics. It's deadlines. It's the moment when time stops being flexible and becomes a weapon. And in the background, premiums are screaming the truth that futures charts try to hide. Dubai at 40% above spot, Japan touching 60% above spot, India paying above official prices for immediate availability. Miners receiving direct offers at strong premiums for fast delivery. These aren't gamblers. These are buyers paying to outrun the coming bottleneck, because they understand that once the choke point closes, you don't get to negotiate with the market. You beg. At this point, some people will hear this and assume it's just another story about prices rising. They'll reduce it to a prediction. Silver to $100, silver to $150. as if the only thing that matters is a number. But the real story isn't price, it's access. The world is entering a phase where the most important question becomes, can you get it? Not what does it say on the screen? Because when price discovery breaks, the screen becomes a suggestion and the physical market becomes the law. The hard data tells you why this isn't speculation. Start with the structural deficit. Global demand has been running above global supply, and it isn't a one-year fluke. Multiple years of deficits mean the market has been quietly eating inventory to survive. That metal had to come from somewhere. Vault drawdowns, warehouse stock declines, stored reserves being pulled into consumption. The visible result of that reality is depleted inventories, shrinking registered supply, and increasingly fragile delivery capacity. This is what it looks like when the market has been living on savings and suddenly realizes the savings are almost gone. Now add China OS licensing system to that deficit environment, and you get a catalyst that transforms chronic shortage into acute crisis. Because when the dominant refining flow tightens, even temporarily, it doesn't just raise prices. It triggers fear in every downstream buyer who understands supply chains. Fear makes buyers act early. Fear makes them pay premiums. Fear makes institutions convert paper exposure into allocated positions. And once fear gets priced into physical premiums across multiple regions at the same time, it stops being fear. It becomes information. Historically, when a futures exchange faces delivery pressure, it doesn't sacrifice itself to honor every contract. It protects the system. It changes the rules. In 1980, when the market faced extreme stress, rule changes came mid-game to prevent a visible collapse. But here's the difference now. This isn't T, driven by a couple of speculators trying to corner the market. It's driven by fundamental demand, supply constraints, and industrial necessity. You can restrict speculators. You cannot restrict solar panel manufacturing without breaking your economy. You cannot cap the demand for electrification without admitting your policy targets are fantasies. This is why the current squeeze is more dangerous. It's rooted in reality, not strategy. So here's the thought that should make you uncomfortable. And it's the one question I want you to sit with and answer in the comments, honestly, without ego. If the physical premiums are already 40 to 60% above paper, and the delivery system is already strained, and supply chains are already tightening, what do you think happens to paper ownership the moment enough people decide they want the real thing at the same time? Not next year, not in some theoretical scenario. In the real world, where deadlines hit, factories can't pause, and short sellers can't print metal into existence. Because this is the moment where people discover the difference between exposure and ownership. Futures contracts are exposure. Unallocated claims are exposure. Even some ETF structures can behave like exposure under stress, depending on mechanics and redemption realities. Physical allocated metal is ownership. And when a market transitions from abundance to scarcity, ownership stops being a preference and becomes a dividing line. Tomorrow, January 19th, isn't a magical switch where the world changes overnight. It's the first domino. It's the beginning of settlement sequences, delivery decisions, procurement panic, and institutional positioning that force the market to confront its inventory truth. Once that process starts, it doesn't stop because you don't like it. It doesn't slow down because you want better entry prices. The machine moves forward because the machine is made of contracts, deadlines, and obligations that have to settle. And in a market like this, the winners aren't always the ones who call the price correctly. The winners are the ones who understood what mattered before everyone else did. They understood that scarcity doesn't announce itself politely. It reveals itself through premiums, borrowing costs, delivery behavior, and quiet policy changes that look boring until the consequences become violent. That is exactly what is happening right now. Now let's do the math that turns this from a story into a trap door. COMEX registered inventories sit around a fraction of what they were just a few years ago, and open interest represents claims on hundreds of millions of ounces across contract months. The entire system survives only as long as most participants accept cash settlement or roll their positions forward. But when delivery preference shifts, when contract holders roll backward into nearer months, when open interest behaves abnormally during delivery periods, when industrial buyers step into the futures structure because they can T-source metal elsewhere, the paper system faces a problem it cannot solve with clever trading. It faces a physical shortage. Tomorrow is the acceleration point. The delivery notices become real obligations. The excuses run out. The metal either shows up or it doesn't. And once the market senses that delivery risk is rising, behavior changes fast. People who were comfortable with paper suddenly become uncomfortable. People who were indifferent suddenly become urgent. The shift is psychological, but the consequences are mechanical. More delivery requests, higher lease rates, more premiums, tighter availability, and a widening gap between what the screen says and what the world pays. This is why analysts begin projecting $100 silver, because the current structure cannot hold its own fiction forever. But even those numbers might not capture what happens if credibility snaps, because if the paper benchmark loses trust, physical markets stop referencing it. The benchmark becomes the price where metal actually changes hands, where supply is real and where scarcity is undeniable. That's when you get regime change, not a rally, not a spike. A change in what silver price even means, and this is the core of the 24-hour window. It is not about tomorrow being the day silver becomes expensive. It is about tomorrow being the day the market begins answering the question that has been avoided for decades. How many paper claims can exist before physical reality forces the truth into the open? Because once the system is forced to show its hand, the entire narrative changes. People stop thinking in terms of spot price and start thinking in terms of the availability price. The price you pay to actually get metal, not to rent the idea of it. This is why institutional money moves early. Those massive inflows into silver exposure at the beginning of a tightening cycle aren't emotional. They're calculated. They were reinsurance purchases by people who have seen what happens when a market built on fractional assumptions meets real delivery pressure. They're positioning ahead of a moment when the system protects itself, when cash settlement becomes the pressure release valve, and when physical ownership becomes the only form of certainty. So here's the bottom line, stated as cleanly as possible. Tonight, right now, 3 groups are racing for the same scarce metal. Industrial buyers are buying because they must. Banks and dealers are buying because they might default if they don't. And Chinese entities are buying because they can, because they see leverage and control in a world that is about to beg for supply. Tomorrow is when their race collides with deadlines, settlement windows, procurement demands, and the reality that registered inventories are not what they used to be. When people tell you this is fear-mongering, remember something simple. Fear is emotional. This is arithmetic. Years of deficits, inventory drawdowns, export constraints, rising lease rates, abnormal delivery behavior, exploding global premiums. These are not opinions. These are symptoms. And symptoms don't appear unless the disease is real. So as the window closes tomorrow morning, understand what's being decided. Not a price target, not a chart pattern. Ownership. The market is quietly dividing into 2 camps, people who hold metal and people who hold claims. And when the market finally forces that difference into the open, the screen won't protect you from reality. Only reality will. And that's why tomorrow matters. Because once this sequence begins, it doesn't reverse. It doesn't politely offer second chances. It tightens, it accelerates, and it reveals what was always true. Paper is only valuable until the moment it has to become metal.